Okay, so you want to own a mansion. Buy the biggest house on the best street, move in, and finally live the way the money was supposed to let you live. 20,000 square feet, a gate with a code, a driveway long enough that you can't see the road from the front door, a kitchen that could feed 40 people, a pool that glows blue at night, a wine room, a gym, a theater, a lawn that somebody else cuts. You walk through the front hall on a Tuesday morning with a cup of coffee, and the house is completely silent, and the silence is the whole point. That's the picture. That's what the listing photos are selling, and they're very good at selling it. The problem is, what happens between the dream and the reality? Not because the dream is fake. The house is real, the pool is real, the silence is real. The problem is that everything you just pictured is the output of a machine, and nobody in that photo shoot shows you the machine. Somebody has to run it, staff it, insure it, heat it, repair it, and eventually sell it. And the numbers on all 5 of those things behave in ways that almost nobody expects going in. Let's start with what you think you're buying. You think you're buying an object with a price. The price is $12 million. You've saved, you've sold something, you've had a liquidity event, and 12 million is a number you can survive. So you sign, you close, you get the keys, and in your head, the expensive part is over. The expensive part has not started. A house at this level costs somewhere between 3 and 5% of its value every single year just to exist. Before you improve anything, before you change anything, before you enjoy anything. Call it 4% on 12 million. That's $480,000 a year to own a house you already paid for. $40,000 a month, every month, whether you're in the country or not, whether you love it or not, whether the market is up or down. That number does not care about your calendar. And here's the first thing that surprises people. That annual burn is not driven by the price you paid. It's driven by square footage, by acreage, by the number of systems in the building, and by the replacement cost of the structure. Those are physical facts, and they don't fall when the market falls. If the value of your house drops from 12 million to 9 million in a soft year, your operating cost does not drop with it. The roof still has the same number of square feet, the staff still shows up, the tax bill mostly doesn't move. You've lost $3 million of net worth and saved nothing. That's the shape of this entire asset, and it's worth holding on to. The value is variable. The cost is fixed. Now, financing. A $12 million house does not get a normal mortgage. It's above every conforming limit, which means it's a jumbo loan, which means no agency is buying it, and the bank has to keep it on its own balance sheet. When a bank keeps a loan, the bank gets picky. Expect 30 to 40% down. Expect a full accounting of your liquidity after closing, because the underwriter wants to see that you still have real money left in the months after you've handed over $4 million. Expect the bank to want a relationship, deposits, investments, the rest of your financial life, because the mortgage is often the loss leader, and the assets under management are the actual product. So you put down $4.5 million and finance $7.5. At a rate in the 6s, that's roughly $45,000 a month in principal and interest, or about $540,000 a year. Stack that on the top of the $480,000 of operating burn, and the house costs you a bit over $1 million a year in after-tax money before you buy a single piece of furniture. The obvious response is to pay cash and delete the mortgage. Plenty of buyers at this level do exactly that, but paying cash doesn't remove the cost. It just moves it somewhere you can't see. $12 million sitting in treasuries at 4.5% produces $540,000 a year. The moment you convert that portfolio into a house, that income stops. The mortgage payment disappears from your statement and reappears as an income you no longer receive. The house is charging you either way. Cash buyers just get charged silently, which is exactly why cash buyers underestimate this asset more than leveraged ones do. Now, here's the other side of the ledger, and it's the one that quietly grows. Property tax. In New Jersey or Illinois or parts of Texas, the effective rate can run past 2%. 2% of $12 million is $240,000 a year, forever, indexed to whatever the local assessor decides your house is worth. In California, the headline rate looks gentler, around 1.25%, but there's a mechanism inside it that catches almost every buyer. Under Proposition 13, a property's assessed value is frozen at the moment of purchase and can only rise about 2% a year. It resets to full market value when the property sells, which means the neighbor who bought in 1988 is paying tax on a 1988 number, and you, the day you close, reset the basis to today. Sit with that. Two identical houses on the same street, same view, same lot, same architect. One owner pays $18,000 a year. You pay $150,000 a year. Nothing about the buildings is different. The only difference is the date on the deed. You didn't just buy a house. You bought the current tax bill on a street where everyone else is still paying an old one. And then there's the thing that changed in 2017 that nobody at this price point talks about enough. The tax code stopped subsidizing you. The mortgage interest deduction is capped at the interest on $750,000 of acquisition debt. On your $7.5 million loan, that means 10% of your interest is deductible and 90% of it is not. And the deduction for state and local taxes, the line that used to make $250,000 property tax bill survivable, is capped, and at the income required to carry this house, the phase-outs push you right back down to a $10,000 cap. So, on $240,000 of property tax, you deduct $10,000 and eat the rest. For decades, the story of the expensive house included a silent government partner who paid part of the carry. That partner left. Everybody who does the math on a mansion using the intuitions they built in the 90s gets this wrong by 6 figures a year. This is where the first trap opens, and it's the one that's gotten violent in the last few years. Insurance. For most of modern history, insuring a large house was a rounding error. You called your agent, you named a number, you paid a premium that looked like a car payment. That world is gone in an entire class of desirable locations, and desirable locations are exactly where mansions are. Two things happened at once. Reinsurance, the insurance that insurance companies buy, repriced hard after a decade of wildfire, hurricane, and hail losses, and construction costs went up something like 40% in 5 years. Insurers don't insure the market value of your house. They insure the replacement cost, what it would take to rebuild that structure on that lot with those materials at today's labor rates. And on a custom house, replacement cost is often higher than what you paid. A $12 million purchase can carry an $18 million replacement figure because the market decided the neighborhood was worth 12, while the plaster crew and the stonemason and the timber framer decided the building was worth 18. So carriers started doing something they'd never done at scale. They stopped writing. In California, major insurers non-renewed policies across entire counties. Homeowners got pushed into the state's insurer of last resort, the FAIR Plan, which caps dwelling coverage at $3 million. $3 million on a house that costs $18 million to rebuild, which means you now buy a wrap, an excess and surplus lines policy stacked on top of the FAIR Plan to cover the remaining $15 million. Surplus lines carriers are not rate regulated. They charge what the risk is worth to them. Premiums of $80, $100, $150,000 a year on a single residence are no longer exotic in fire country or on the coast. And there's a clause inside that policy that quietly punishes exactly the person who buys a house like this. Most residential policies restrict coverage once a home has been vacant for 60 consecutive days. Vandalism, water damage, glass breakage, coverage narrows or disappears. Now consider who owns a mansion. Frequently someone with 3 homes, an office in another city, and a travel schedule. The house you visit 8 weeks a year is, from the underwriter's point of view, an abandoned building with a wine cellar. The fix is to have someone there. Which brings us to the part of this business that people romanticize the hardest and understand the least. You do not own staff. You employ them. The moment you hire a housekeeper who works set hours in your home, you are a household employer. You have a federal employer identification number. You withhold and remit taxes. You carry workers' compensation. Because in most states, a domestic worker who falls off a ladder in your house is a claim. And your homeowner's policy is not going to want it. You track overtime because household employees in most jurisdictions are non-exempt, and the hours over 40 pay time and a half. You handle terminations. You handle the fact that these people are in your home, around your family, with keys and codes and knowledge of when you're gone. Run a real estate at 20,000 square feet on 3 acres. And the roster is not one person. It's a housekeeper at 70,000, a second housekeeper or a part-timer for the heavy weeks, a groundskeeper or a landscape contract, which on 3 maintained acres with irrigation, hedging, seasonal color, and tree work runs 60 to 90,000 a year. A house manager or estate manager to run vendors, schedules, projects, and the other staff. That role, done competently, is 130 to 180,000. Add payroll taxes, workers' comp, and benefits, and you multiply every salary by roughly 1 1/4 to 1 1/3. Add it up conservatively, and you're at $300,000 to $400,000 a year in labor. That's not the roof. That's not the tax. That's not the insurance. That's just people. And here's the sentence that reframes the whole thing. You didn't buy a house, you founded a company. It has a payroll, an HR exposure, a vendor list, a capital expenditure schedule, and an annual budget in the 7 figures. What it does not have is revenue. Every business you've ever studied has a top line that pays for its bottom line. This one has you. Now the building itself, because buildings at this scale don't age like houses, they age like small hotels. A 20,000 square foot house has